Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is September 2nd, 2025, and we're diving into the latest earnings report from C3is, a ship-owning company specializing in dry bulk and tanker seaborne transportation services. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. C3is has just released their second quarter 2025 financial results, and there's a lot to unpack, from their operational highlights to financial performance.
Revenue and profitability overview. Let's start with the revenue and profitability. C3's reported revenues of $10.7 million for Q2 2025, slightly down from $10.8 million in the same quarter last year. However, they posted a net loss of $5.3 million. John, what are your thoughts on these figures?
The revenue dip is marginal, but the net loss is significant. The decrease in the average time charter equivalent, TCE rate, which fell by 31% compared to last year, is a major factor. This decline in TCE rates has impacted their profitability, leading to an adjusted EPS of -51.
And what about their fleet utilization?
The fleet operational utilization was at 78%, down from 87.7% last year. This is mainly due to the commercial idle days of their Aframax tanker operating in the spot market, which has affected their overall revenue generation.
Operational efficiencies and future outlook. Moving on to operational efficiencies and future outlook, C3is has a cash balance of $2.3 million and has managed to remain debt-free. How does this position them for future growth?
Being debt-free is a significant advantage, especially in the volatile shipping industry. It provides them with financial flexibility to navigate market fluctuations and invest in growth opportunities. Their fleet capacity has increased by over 230% since inception, which is impressive.
What did the CEO have to say about their performance and future prospects?
CEO Dr. Diamantis Andriotis highlighted their solid performance despite geopolitical and environmental challenges. He emphasized their strategic focus and resilience, which they believe will support future growth and adaptability in a changing environment.
Cost management and financial adjustments. Let's discuss cost management. Voyage expenses increased to $4.7 million and operating expenses were $2.4 million. How is C3is managing these costs?
The increase in expenses is primarily due to the higher number of vessels. However, they've managed to reduce interest and finance costs significantly, from $0.9 million last year to just $0.04 million this quarter, thanks to repaying debts related to vessel acquisitions.
There was also a non-cash adjustment related to warrants. Can you explain that?
Yes, they recorded a $6.4 million loss on warrants due to changes in fair value. This is a non-cash item, but it does impact their reported net income. It's important for investors to differentiate between cash and non-cash impacts when assessing financial health.
Key takeaways. In summary, C3 has faced some challenges this quarter with a net loss of $5.3 million and an adjusted EPS of -51 cents. However, their debt-free status and strategic fleet expansion position them well for future growth. John, any final thoughts?
C3is navigating a tough market with strategic resilience. Their focus on maintaining a debt-free balance sheet and expanding their fleet capacity is commendable. Investors should keep an eye on their ability to improve TCE rates and manage operational costs.
Thank you, John, for your insights. And thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch for more financial analyses. We'd love to hear your thoughts on C3's performance in the comments below.